Welcome to this week's edition of Trade the Trend, a weekly video about where the stock market is heading. This video is going to focus on the SP 500. I'm going to cover the ASX 200 as well as copper, gold and uranium in a separate video. I'll leave a link for that in the description section below. As always, this is general commentary, doesn't take your personal situation into account. With all of that said, let's get into our first chart. So I've got the SP 500 up on the screen, and look, what a big week! What a big week for the stock market, up 5% in 4 days. So that's a pretty extraordinary run. The bounce has been, this bounce has been significantly stronger than I was anticipating. We spoke about the potential for some sort of a near-term bounce last week, but this is above and beyond what I thought was likely. And from where we were last week, sure, prices were stretched below these moving averages, and they had broken to a new low. But this is one of those powerful recoveries. And it's actually what's interesting. The recovery has been more powerful than the sell-off leading into it. And what I think happens now is that this upward trend channel, which I've had on the charts for a few weeks now, I think the validity of this channel is now being questioned, with the price coming right back to the upper boundary. I'll leave it there this week, see what the price action is like, but this is one of the structures which may no longer be useful. And I think the big question now is, where to next, and have we seen a significant low point? So what I'm going to do over the next few minutes, I'm going to take you through several key indicators and just start to assess what this price action over the last few days could mean. So I think the key feature really for me that led to me, like if you're watching last week, you would have heard me say, look, I sold my S&P 500 index position, which I'd had since down here the October last year. The key reason for that was the break to a new low. So we had this sequence of lower highs and lower lows, and then a new low, and also the declining moving averages. And so that was the reason for me to exit the position. And those vulnerabilities still remain. That's still the current setup that we have. I think that it's interesting that markets can bottom the way that we've seen the price behave over the last weeks. Significant lows can occur like this, but then they can also quickly reverse course also. So we only need to go back to May 2022. We saw a similar strong rally from an oversold position, which then within 2-3 weeks gave way to new lows. So it's not a clear-cut situation of, okay, we've had 4 strong days, so this is all over. There are still vulnerabilities. As I say, we do have the sequence of lower highs and lower lows and a declining moving average. So that part hasn't gone away. I think for me, the best case scenario would be for the market to track sideways for a week or 2 or 3, establish a base, a platform at a higher level, and then from there break higher, and then sever that sequence of lower highs. That would be nice, clear-cut price action. That will take a little bit of time to play out if that were to happen. A possible positive for the market is, I want to show you this indicator. So this is down below. I've got 2 things on this chart. Down below, it's showing you the number of S&P 500 stocks above their 50-day moving average. And at the top, we have the S&P 500. Now, I showed you this, I think it was 2 or 3 weeks ago. And I was showing you this. This was this indicator. This is an interesting indicator because when the number of stocks below the 50-day moving averages declines to below 20, which is this horizontal line you can see here, below 20, and then rallies back up and breaks back above 20, that's the trigger point. And you can go back to the old video to get the full analysis of it, but you can just see from these couple of examples, when that has happened historically, it often leads to a point where the market does see some upward momentum. So the point I made a couple of weeks back was this played into the view that I had that the pullback from the July high was a pullback, not a reversal. And I thought that we were more likely to see some upward momentum develop from that. But instead, we didn't get that. We got a nasty retest where the market fell again, and the indicator came back into the sub 20 zone. But now we have a situation where now it's triggered again, back above 20 and rising. What was also interesting during the decline was whilst the SP 500 made a new low, you'll see the number of stocks below their 50-day moving average didn't make a new low. They didn't get lower than the number didn't get lower than it did in early October. So that's some divergence, which is a positive for the market. So this is something to keep in mind. I think this is a near term. It's probably a near term support. It's probably a near term positive for the market. If this indicator continues to rise, as it historically tends to do on these breakouts, that's likely, I think, probably to see more strength in the market, at least in the near term. I think that the biggest concern I've had through this whole pullback has been breadth, and something we've spoken about in the past. This is the S&P 500 equal weight ETF, and it's been significantly weaker than the S&P 500 through this period, this previous period. It's coming off oversold conditions at the moment, but the overriding momentum, it does remain to the downside. So yes, I think there's some near-term upside potential, but I think we need to see what the upside potential looks like. Like I was saying, the S&P 500 just go up and then sideways, build a base, and then start to ratchet higher, get above moving averages. Moving averages start to turn. All of that takes time. It's not something where I think we should anticipate the market just continuing to go up like we've seen in the last few days. The way I've been playing this for the last few months, it's been reducing risk the whole way down. As the market's been coming off, I've been reducing risk, and I'll typically have my smallest position when the market reaches its bottom. Whether this be a final low or not, I don't know, but that's when I'll typically have my smallest position at the lows, and then it's a case of adding risk as prices rise and we start seeing new breakouts in stock. So it's really more a case of tapping at the controls rather than lurching from one side to the other. So I'll really be, I'll really go from all bullish to all bearish. It's more that case of that gradual shift. If this happens to be a meaningful low, it'll be a gradual shift back to reinvesting. If it peaks out, it'll be a case of continuing to gradually unwind as the situation develops. Now, I want to quickly go over and show you the NASDAQ. Look, was this a false break? You'll know I've had this what I thought was a bullish flagging formation. Big upward rally, classic flagging formation, but then we got a break to the downside a week ago, and then a snapback rally. So look, you'd say, yes, that was a false break. I think it pretty much, I don't think we can really call this a flagging formation anymore. That's not how flagging formation works. Probably the price action would have stopped around the 100-day moving average and rallied if it was going to be a classic flagging formation. So something else is at play, but it was certainly some sort of a false breakdown. And for me, that was a vulnerable point when the market broke to a new low last week, below declining moving averages. It was a trigger point for me to shut off risk, and it's just one of those frustrating things we all experience when you've been in the market for a while. You know how this is, where you move one way and the market then moves in the opposite direction. And it can be frustrating to see that reversal, of course, once you've shut down some risk. But this is the important point to remember. Shutting down risk is something that you survive. Yeah, it's a bit frustrating, but you survive that and you come back and you can reestablish positions if prices continue to move higher. What's worse, I think, is when you ignore key pieces of price action, of breaking lows below moving averages, when you ignore that sort of thing, when you start to fade that and say, well, look, I'm going to hope for the best. I'm going to hope the market rebounds. That can lead to disaster. Hasn't on this occasion, but it can. So it's about playing setups as they should be played and not playing on hope. And but for now, whilst this October low holds, I think we've got to maintain some sort of an upward bias, although for me, it's not a high conviction upward bias. Now, if you're getting some value from this, please hit that like button. Please leave a short comment. Just, hey, thanks for the video. It just tells YouTube you're watching. YouTube shows other people. It helps me heaps. And hit that subscribe button if you haven't already. Now, let's just jump over to the Russell, wrap up with a couple of last little things. Russell briefly hit a 3-year low last week and now has rallied off that. Can't really call this a false break because it's I don't think it's really ever broke to the downside. It was sort of like nudging these previous low points, but I don't think it's really a full on break. For me, this remains a range bound market. We're at the bottom of the range and we're rebounding from what looks like an oversold position. Bit like the SP 500 and the NASDAQ. I think there's potential for some of the bearishness of October to be unwound. Probably more so in this than the other two, simply because this has been the most oversold. But this, when you look at this, it still isn't a strong technical structure. This still could turn into some large basing formation, but there's nothing here at the moment to tell us that this is primed and ready to go, other than coming off some support from an oversold position. I'm prepared and I'm comfortable buying individual stocks based on their own unique setups, when they're above moving averages, when they're breaking higher, and there are stocks that are doing that. But in terms of buying the index when it's in this sort of situation, I'm just not so keen to do that. I'm not in a hurry to move on a lot of these indices at this point in time. I'll see how this bounce plays out and continue to assess. And one last thing which is worth having a look at, it's this US 10-year bond yield. And this is something we spoke about, I think we last spoke about 2 weeks ago. I was pointing out the divergence we had in that the yield was getting up to this critical 5%. On the weekly chart, you'll see it in the video from 2 weeks ago. There's a big resistance point at 5%. Market has rallied into there, but then when we put the RSI on, we've got some big divergence going on where the RSI is not making new highs with the yield. We've now got the yield coming off. If this continues to unfold, that's probably going to help underpin stocks in the near term. It probably does remove a lot of that big vulnerability that we did have a week ago. And then it's the case. Let's see how the price action evolves. And look, the way I see this, we're still dealing with significant cross currents in these markets. I think the play is just keeping a rein on risk. Play this conservatively. Keep an open mind to the price action as it develops. I just don't think this is a time for rigid views in either direction. I think rigid views are likely just boxing you in, and I think we need to be mentally flexible to just shift with the price action and see how it unfolds. So look, thank you for joining me. It's been great having you with me. I look forward to coming back and talking to you next week. Till then, bye for now.